Good evening and welcome to Your Money, Your Call. Joining us tonight on the panel we have Roger Montgomery, who was on the show earlier, our investment expert. And
thank you very much, that's very kind.
Roger, I think by Friday last week we'd got through 50% of reporting. Now we must be along the way to about 75% of companies reported.
Yes.
Very big day today. We're having Santos, Woolworths come through, and on that, how are the companies you're covering looking?
Well, I've been writing
really
the last couple of posts that I made on my blog have been the shifts, the changes to the quality ratings. As you know, I rank companies based on, from A1 down to C5. So I've been reporting on companies that have come into that A1 quality qualification, if you like, and also the ones that were the companies that were A1s but have dropped off. And there's been a few changes, but
Primary, I noticed, was what?
Yeah, Primary's actually come up to an A2. That's because they've done a capital raising, and look, you've got to remember the A1s and A2s. What that does, it doesn't mean that their share price is going to go up. It doesn't necessarily mean that you're going to get a great return from investing in the shares. That comes from the price that you pay and whether or not the intrinsic value of the business is rising. What it does, though, is it tells you whether or not there's a high or low probability of those companies actually defaulting or falling into bankruptcy. So an A1 or an A2 business has a very low chance of that occurring. So I've listed all those companies on my blog, and as we go through some of the calls today, I'll be able to tell people what they are now.
Fantastic. All right, well, we'll probably move on to the first caller now. We've got a caller. We've got Jason from Melbourne. Good evening, Jason.
Thanks for taking my call. Just a query in regards to Nexus Energy. Can I just get a technical view on that? I know Roger won't like the stock, so he's going to say it hasn't been producing solid earnings, so you won't need to put a value on that. Just a technical view on it, and if you've got time, Westpac as well, one which Roger should like.
Roger, do you want to have it? Because I think Westpac is worth looking at because you had that massive 20% drop.
Yeah, the business is now below an estimate of its intrinsic value, and that intrinsic value is expected to rise over the next couple of years. And just to actually put some numbers on that for you, I'm expecting the intrinsic value of this business to rise by about 8% over the next 2 years, which is not huge. It's not 15%, which is what you'd really like. But the bigger the discount you can buy it, compared to its intrinsic value, obviously, the bigger your internal rate of return. So this business I value, Westpac's value is $23.59, and that's rising to $25.30 next year and $27.52 the year after. So look, the reality is that the banks are in a great competitive position, all four of them. The costs associated with changing banks is much higher than the perceived benefit of doing so. So as I said on a couple of programs now, if you live on an island and you can own a business where you charge someone to put money in, you charge someone to take money out, and you charge someone to look at their money, that's a pretty good business to own on an island, and Westpac's one of them. Having said all that, I think over the next couple of years we'll see a divergence between within the four banks. The Commonwealth Bank and the Westpac Bank, I think, are going to be better performing businesses, and the NAB and ANZ less so. And I think the best of the lot is the Commonwealth Bank in terms of business performance. It's generating the highest return on equity, and it's done that because it got to buy Bankwest at a very good price.
Right, okay. I guess your model would be interesting to see where you actually do put the money, because it's always a big question which of the big four place your money at the time.
If I was going,
being able to rank them.
If you put a gun to my head and you said, Roger, you have to make a bet on one of them, it's going to be the Commonwealth Bank pretty much every time.
Next we have Alan from Newcastle.
Good evening, gentlemen. My question revolves around Monadelphous, one of Roger's favourite. I'd like an intrinsic value assessment from Roger, and also a technical analysis as well. Thank you.
Yeah, look, this is a business that many other businesses aspire to be. So, when I'm looking at mining services businesses, this is the one I compare all the others to. It's a terrific business, and its intrinsic value at the moment, $14.75, which is above or just about its current price. But that's rising to $16.22 next year and $18.40 the year after. Now, one caveat. I have a view, and it's just my view, and I don't make investments based on this view, but I give it to you as a piece of information so that you can think about it in the context of what we're talking about, and that is that China is pulling back. The government has been insisting that the banks over there reduce their loan-to-value ratios. They've got to bring a whole bunch of debts onto their balance sheets, which were previously off balance sheet. I think the result of that will be a slowdown in infrastructure spending. I think it'll be a slowdown in price appreciation for property. And those two things combined will mean that there'll be lower demand for inputs, resources, so things like iron ore and coal. That could have a negative effect on prices, and I say it could have, I'm not saying it will have, but it could have a negative effect on prices of iron ore and coal, and I think the impact on that on the share prices of the resource sector could surprise you on the downside. Now, as you know, I don't predict share price movements, but I just want you to be aware of that concern of mine. Having said that, I like owning the suppliers of picks and shovels in this space, and Monadelphous is one of those businesses. Another one is Matrix Engineering, there's Forge Group and Decmill as well. Those four are all A1 businesses. I think they're excellent businesses and they're in the right space at the moment.
Our next call on the line is Brian. Brian from Perth.
Yes, could I get a panel's view on Fleetwood FWD, and do they know, have they reported yet? Thank you.
I think they have. Roger, I know this is one of your...
Yeah, they've just reported.
Yep, okay.
I have to confess I'm an owner of shares in Fleetwood. So, I just want people to understand that anything I say, they have to understand that I own it. I think it's a great business. There's been opportunities to buy it at substantial discounts to intrinsic value in the past. Today is not one of those opportunities. The business is trading around the $10 mark, $9.70 to $10, around that mark, but its intrinsic value is about $8.41, and it's not going up at a substantial rate over the next couple of years. Having said that, though, it is a terrific business, and like Monadelphous and the others, it's at the moment it's enjoying a sort of a violet patch, so a really nice period for it. Doesn't mean it's cheap though. You want to have a great business and you want to be able to buy it cheap. It is a great business, but it isn't particularly cheap at the moment.
Roger, do they have any competitors on the horizon at the moment? Because it is an area where I can't imagine the barriers to entry are very high. You set up a factory, start building.
Well, reputation's the issue here. It isn't just building caravans and building portable accommodation. You've got reputation, you've got your capital outlay. There are competitors in that space, and they have been there for a long time, and this is a business that still produces superior returns on equity. The time to buy this is when it is at big discounts to intrinsic value, and the last time that actually happened was during the global financial crisis and shortly after, and it was trading at a good 40% discount to its intrinsic value at that time.
What sort of yield is it on at the moment? Traditionally, it's had some fabulous dividends.
You'd know better than me. You're a broker. I don't look at yields and PE ratios.
Right, okay.
I'm interested in intrinsic values.